Welcome to week number 3 of the year on how to trade the Forex calendar. Before I crack on with the flows and we have a look at the macro data, I'd like to address the options market and the chaos it caused last week, particularly on USD assets and the S&P 500. So just to recap the week, we started the week with USD bid. Euro USD fell quite a lot in the beginning of the week. I'm gonna highlight the beginning of the week. So we're looking at GBPUSD. Let's have a look at Euro USD. So beginning of the week, Euro USD had quite a dive, which was on this candle here. Had a dive, it played about, and then the valve released again on Friday. GBPUSD experienced a little bit of a different story. Now, the fall behind Euro USD was a little bit more calculated. We knew that on the weekend, and it wasn't really a surprise. What happened with GBPUSD was a little bit more out of the norm. So it followed the dive with Euro USD. By 2 o'clock on Monday, one of the Bank of England members said that there will not be touring into negative yield policy. Now, there was a bit of a build-up in the GBP complex that there might be, or the Bank of England might be introducing for the first time, negative interest rates, and GBP had a slight risk premium built into that. I believe the futures market have discounted that up until I believe May, it was August. Now, they pushed that back following her comments. The day after that, which would have been Tuesday, the head of Bank of England, Governor Bailey, said he is not interested in negative rates and he doesn't think it will work for the UK. So the whole couple of days, all the way leading up to Thursday, we saw a repricing of the yield curve for the UK, and that sort of got priced out. That's why you saw GBPUSD bouncing, even though Euro USD was continuously trading lower. So there was sort of a divergence, which was very bizarre, but the explanation was that. Now, come Thursday night, and Biden's stimulus plan gets announced. I believe it was 1.9 trillion. It still needs to pass the House and the Senate, which is a different story. But he said something in his remarks that really made everybody worry, or reignited the worry that everybody had during the election. He said everyone will pay their fair share. He was talking about possible increases in taxes, specifically taxes on dividends, capital gains, higher incomes, and companies. Now, the taxes he's proposing aren't hugely devastating and damaging to the economy, but what it does do, it puts people off getting the dividends out, because they're going to get taxed on the dividends, and they will change the structure that possibly investors might view this year. However, that was just a small note, and that kind of gave risk sentiment a nudge. I'm going to bring up the S&P 500. We have a look at that. Just trying to reconstruct the story that was behind all these moves. So that's the CFD, pretty much same idea. So this is Thursday. Already had a bit of a touchdown. Come Friday, there was a more important story unfolding. It was the huge option expiry on record. I believe one of the biggest since 2015. A hell lot of amount of call options expired, and to the leading up to that, there was a bit of a gamma squeeze going on. Just to quickly explain what gamma squeeze is: when investors buy call options, the option writer buys stocks of the underlying asset, so they're net balanced. That means they can't necessarily use any huge money on that. So as investors kept buying call options, the option writer had to continually buy those stocks. They call it gamma squeeze. Basically meant that the continuous rise since December was mostly behind the call option and the gamma squeeze, and on Friday 35% of that expired. That means the option writer had no need for a lot of the stocks they bought, and they released that. I believe the call option strike was for about 38.50. So market actually never traded as close to that. So there's a lot of people currently on the water. There's another worry right now that because a lot of these options came off, the option writer has less of an incentive, or it's going to be less supportive of buying more stocks to support the option. So it's a bit of a dynamic going on right now. It doesn't mean necessarily S&P 500 will just keep falling from here. What it means is S&P 500 will continue to trade very volatile until majority of those options are cleared. And think the put-call ratio comes a little bit back into balance. So it was really a lot options driven, option flow driven, and dealers trading that drove most of the flows last week. So if you were possibly entering based on news, or if you were using your sentiment analysis, a lot of things did not add up or did not make sense. Things would move and just radically turn back again. That was really just because of these flows, and it's important to understand that to see why these things happen. That gives a bit more encouragement to enter into the next weeks, knowing that what we left behind, what's still to come, just puts your head in the right space. Now going forward, I'll go back to GBPUSD just so we have a little bit of a continuity of that story. So coming to Friday, a lot of the options writers and dealers sold their stocks and dollar rises when they sell because they get their dollars back, and that kind of punched GBPUSD for a couple of levels. It's still off that level where Bank of England said, look, we're not going to do negative interest rates. Usually the case is first it gets repriced or priced out, negative rates for Bank of England in this case, and then usually you tend to see that markets trade back to the level, so it goes together where Euro USD is. So Euro USD and GBPUSD are extremely closely correlated. You will find that on a daily, day-to-day basis there will have divergences, but on these bigger swings on a weekly basis, it's very unusual to see Euro USD tanking 200-300 pips, but GBPUSD is up nearly 200-300 on the week. So I really expect GBPUSD to, just on a flow basis, not even using a news catalyst, to just crawl back into where it started off the week before. Again, this just was a quick recap. What happened last week was a little bit distorted, where a lot of the news reporting wasn't really coherent either, so they would just stick labels onto things that were happening without really finding the core reasons behind things. So now we know that. Now we know most of it was options driven. There's possibly more come to in the following few weeks. I believe we got a better understanding of where we stand in terms of flows and also in terms of incentive. But let's have a look at data and have a look at what lies in the next week ahead. I always like to start my week with the CFTC data. If you don't know what it is, basically every Tuesday, big institutions, big traders, they have to legally comply and report their positioning to the commitment of traders to the CFTC, and they publish that on Friday. So the data you will see is usually a few days old, but it does explain a lot of the bigger moves that happens in the shift. So I always like to have a look at this report for two reasons. One, it tells me who's the most vulnerable in the market, who's got a bigger position and could possibly get squeezed, but also tells us a story if the trend in prices are supportive. For instance, if we see prices are climbing and the positioning building up behind that climbing as well, it gives a bit more confidence that this is a healthy market with some good volume behind it. Most of you are aware of how CFTC data or CFD data is. Quickly going through, surprisingly, USD been sold again last week. So Euro longs climbed to a massive near to 24 billion, mostly on the back of shorts covering the position. So it was quite a big unwind on the short positioning that helped the long position, but also renewed long position built up. Open interest quite healthy at 677,000 contracts, which is quite decent, the highest in the last 4 weeks. There's just one thing that worries me, is that all those Euro USD, all those Euro buyers that bought it last week and the week before, they're pretty much all underwater now, as Euro USD is trading under 1.21. So there's a worry that they could possibly unwind some of their positions, and we have a scenario like we had in April 2018. Mind you, the scenario we had April 2018 was a bit similar. We didn't have the extreme positioning, so here's the April 2018 top. So the positioning is far off that. And one of the main reasons Euro is climbing is not necessarily just because of Euro, it's because of the whole reflation trade in the world, and that has not fallen apart yet. So suspecting that there will be a big position unwind at this point is a bit premature. Be that as it may, there's a bit of a worry starting to creep in. We know that Europe is, most of parts of the bigger economies in Europe, going to be in lockdown until April. That's not faring well. On the other hand, United States, as vaccination is going really well, the lockdown's mostly getting lifted, and the economy is not likely to contract at all like in Europe. Europe's probably going into double-dip recession. US is going better. The latest stimulus bills in the United States are really putting American assets into really an attractive position. So it seems to be a little bit of a shift. But it is a very early shift, so I'll keep an eye on that to see if there's going to be in the next week a positioning change on this front that shows us that longs are getting worried. But so far, most of the last few weeks and most of last year, long positions were very strong, and they didn't have really much of a worry. Moving on to, sorry, I said that the April 2018 were these, there weren't these, that's just a few months back, but it was a similar scenario. Moving on to GBPUSD, we had a big position build up of the long side as well. It's over 1 billion just now on GBP longs, quite strong positioning on the long side, but shorts added as well. The good thing that's in favor of UK is they got two of the biggest obstacles that was holding GB rally back last year away. So one was Brexit, the uncertainty of it and what it will bring. And the second one was the vaccination. Vaccination is going good and is likely to continue. It's one of the fastest, I believe UK is doing one of the fastest vaccination across all of the G10 countries. So it's really positive that UK economy will come out of the recession quite quickly. However, it's very likely going to double-dip recession just like the Euro is about to do. So I'm a bit worried about GBP on the short term, but more constructive on the long term. It is always a bit worrying when you see this big position built up into a risk-off situation like we had the last couple of weeks. That's not very encouraging. I like to see a good positioning where prices have dipped. That's when you know that you have a stronger hand in the market, and the participants that have entered have likely entered on a dip, but I'm believing in the trend up. But here, if you see us on a push higher and you see a big positioning built up, sometimes, not always, that means that maybe there was a degree of FOMO involved, and maybe these are weak longs. Specifically, I believe there was a good build up at 135, 136. Now GBPUSD climbed all the way to 137 and started coming off again. I'll be a bit more cautious again. I feel long term to medium term GBP still a good long, and the short term there is a bit of a worry building up. Having a look at AUD, we just turned from negative to positive. Again, not an ideal place to go positive when you're at quite a high and prices start turning. Most of the positions that built recently are mostly underwater now, and market will likely test their resilience. You really need a strong yuan to come aid the market here, otherwise it's going to be very, very bumpy for all the USD bears in the short term. Having a look at inflation expectation 5/5, we have overlaid AUD/USD with it, as AUD/USD is one of the major commodity exporting countries that always benefits from a rise in inflation expectations. As you can see, the chart is pretty much a copy and paste. I always like to look at little divergences that I can see from one to another. So you can see Friday ended for AUD/USD bearish. It touched under 77 cents but managed to close above it, which is a little bit more constructive. Inflation expectations were still going strong. On a relative basis, you would think that this should aid AUD/USD, and AUD/USD should climb back up towards a 78-cent level and make higher highs again. Again, backdrop for Australia is pretty good. Their lockdown is going to be lifted way before everyone else. Commodity exports good. China is rising, which is taking the Australian economy with it. So there's lots to love about AUD. So the dip on Friday was caused mostly by option market, and options flow should or could get reversed. And we've got data to look at shortly. Going into next week, we start in the Monday with a holiday for the United States. I'm not expecting a lot of movement on Monday, specifically after London session sort of dies down. Early hours, we have Chinese quarter-on-quarter GDP. It's incredible how they rebounded from the recession, coming out stronger than they started last year, which is remarkable if you think about it. That could help AUD, but from my experience, whenever the GDP data comes out, it is already well in the price. Having a look at AUD, which is probably one of the currencies that's gonna benefit or lose the most at the GDP print, this level is very crucial on the AUD front. We already had a couple of dips at it. A market tried to climb the 78 cents level. That usually tells you a story here that the bullish run is coming to a bit of a pause. If that pause could turn into a dive is yet to be seen. I wouldn't want to speculate too much further. It really comes down to risk sentiment, and risk sentiment has got a lot good going for it and a lot bad. So we have vaccination that tells us the rest of the world economy is rebounding in the second and third quarter, but we have a rough start to the year. So it really comes down to how you want to trade it. Unfortunately, if you're taking short, you will be doing a counter trend trade, as AUD/USD is obviously on a major tear. But in the short term, and consistent with the AUD moves we tend to see after China GDP prints, we tend to see a bit of a dip. So ideally, I like this entire level to go into the jobs data, or possibly before it. I like a nice dip out of 76.20 to start taking on highs again. Risk sentiment dependent. Moving to Tuesday, there's no particular data that hugely interests me. I'm more interested in what happens to GBPUSD. I'm quite bearish GBPUSD beginning of the week. I'm expecting about 140 pip dive. I'm expecting GBPUSD to converge to where EURUSD is and take out this entire range down here. About quantity to 140, 100 pip dive. If early Sunday opening on Monday we get a touchback into this level, that would be my trade entry and also my stop loss trigger, which covers about a 20 odd pip zone, give or take, for your spreads to take out this entire range down here, which would be a decent payout. If it doesn't touch back there, I'd be more interested to maybe use one of these data points that I get on Tuesday. We have good data points from the UK, which is the UK data is not out until Wednesday. So we have the CPIs and the PPI output from UK on the Wednesday, and I believe retail sales later. So we're using one of these data points to navigate a short, just to really neutralize what happened last week. There was a bit out of whack, and it did not make sense with the other flows. And then we have Canadian dollar, which is of interest to me as well. We are currently in the commodities, as everybody calls it, commodity super cycle, which I believe started in the late 90s, took a breather between 2013, 14, correct me if I'm wrong, till about now. And a lot of economists and a lot of macro strategists believe that the commodity super cycle is about to continue, and that should continue to aid the Canadian dollar, Australian dollar, New Zealand dollar, which are sensitive to commodity prices. Not only based on that, but also based on the Bank of Canada report coming out on Wednesday. I'm not really expecting any negatives coming from them. The short-term yields we have a look at as well isn't really exuberantly priced. They have been diving continuously, which is consistent probably with USD CAD finding a bit of a bottom. Be that as it may, I'm not really expecting Bank of Canada to make any rate moves, so that front running of the short-term yields is likely to reverse or stabilize, which should help USD CAD to make a move lower. Now, in terms of levels, I find USD CAD really difficult to work with levels, so be really working with data. Ideally engage with Canadian dollar after the rate decision, just to really understand, make sure they're staying neutral, and start to think about moving lower again. My medium-term target, or going into next month, would be 125. So I'm still expecting a move lower on USD CAD into probably going to the beginning of next month. I'm not expecting this to happen very quickly. Very constructive on oil as well. So we had a lot of news coming out that Saudi Arabia is supporting lower prices. A lot of analysts came out and said oil probably topped out for the rest of the year around these prices because of the virus and all of that. The reality is that oil prices are really supportive. Market is really behind that bullish move, and major dips continue to get bought because there's good demand in the market and the supply side is really straining it. So I'm really expecting oil to still pick up and find a nice trend continuation higher. In terms of levels, it's a little bit more difficult to find out where the levels will sort of find the equilibrium. About 60 for WTI is proportional on Brent. Again, these would be a bit more longer term targets for these commodities, and on Brent, ideally a move back to where we had it on pandemic levels, closer to above 60-68 would be ideal, as long as Saudi Arabia and OPEC Plus are accommodative to these oil prices, which in turn will help Canadian dollar as well. Again, a little bit longer term view. We have a look at the Australian dollar with their employment data. Now there's a good and bad thing about it. The good thing is we're expecting a bit of a dive. We're expecting this level to go. And what's helping is probably going to be the employment data. Expectation is that employment growth in Australia is going to fall. That will cause a little bit of a negative feedback loop and hopefully drive the currency lower. What is not yet known is if market will start swooping in and pick up Australian dollar on these cheaper levels because of the whole outlook on commodities and vaccinations going on. So that will be a little bit more tricky to time. I'll be having a sharp eye on what happens during the employment data and how market moves around that, but I'm very constructive on Australian dollar moving towards the end of this month. But next week will be a little bit more tricky because we have the inauguration, and on 19th of January we also have Janet Yellen to testify, I believe, for Treasury, and how she's going to stand on a strong dollar sort of narrative. There's a lot to decipher between Wednesday and Thursday. So not necessarily get very aggressive, but the whole idea of AUD higher is pretty much intact. Moving on to the same day, we have the ECB announcement. There's nothing expected. The normal pattern for Euro USD has been around ECB, very, very similar. It's been literally like that. Either it's been moving up to the run up to the ECB, and then it starts spiking and continues falling lower, or it's been basing before the event, and once the event is passed, it tends to climb afterwards. So in this scenario, we have Euro USD already falling since Wednesday, where Democrats cleared the Senate in the United States. We saw the strong sell-off. I'm expecting that the range of 20.50 to 20 to the bottom of here, Euro USD should find the bottom. If it starts cracking, there will be a long way down to go, because there's going to be a lot of euro and white possibly to follow. There's a big big interest around that big round level. Don't get particular about spikes. There might be a little bit bleeding on the price, but I'd be very interested to how Euro USD fares coming out of the ECB event into the PMI data. The PMI data on the manufacturing been good. On the service side, been very devastating because the economies are mostly shut. So there's a lot of bad news already known. Most people already anticipate that Euro will be in a recession, and until April things are not picking up. ECB already made everybody aware of that. So there's a lot of information already known to the market, and Euro already seem to have priced a good chunk in. The question whether will be Euro on the Euro side, where COT data shows they're extremely long, will they be starting to unwind some of the positions that can hugely accelerate this downside move very rapidly. It's not the base case now. The base case is we really start bottoming around here and start find a bit of a surge going into the last week of January. So again, to recap, beginning of the week, I'm expecting GBPUSD to make a quick move lower to touch base with the rest of the currency complex, specifically Euro USD, as it missed out on the drop. On Wednesday and particularly on the 19th, on the 20th, on 20th we have the inauguration on 19th January Yellen. We'll be looking to see how market perceives all of that, and if the inauguration is a risk of sentiment, as everybody is telling us. It feels a little bit overcooked, the whole idea of risk of sentiment. So we just had more stimulus announced, still to pass Senate and the House, but there's a lot of supportive factors that tells me that S&P 500 and as a result all the other risk currencies should really be trading higher. So again, this sell-off was all options driven. The rest of the week was really pretty much on the upside. This was mostly options driven. Unfortunately, this also meant that S&P 500 is now down on the... Is it down on the year yet? Let me see where it opened on the year. So on the year it opened around... I'm looking at the CFD. Let's have a look at the futures. So on the futures, it opened around here. So it bounced on the yearly open, which is really constructive. What is still a bit of a worry is that the gamma squeeze is probably gonna be less effective going forward because there's less call options. So I'd be very, very keen to see what happens around this yearly open. Again, constructive that we saw a spike, but going forward, really risk should be on. There's not a lot to see why risk should be off. Having a look at VIX as well. Volatility Index, we had another spike, and these spikes have been selling off for the better part of last month. We continuously saw a move lower. My base case is, again, we're going to see sub 20 S&P 500 move towards 4,000. Last week was a little bit of a hiccup. I think the positive move should start continuing post inauguration of President-elect Biden, which should in turn help AUD lift up as well if the whole risk scenario comes together. Keeping a keen eye on that. So beginning of the week it might be a little bit clearer. We're moving in the middle to the end of the week, really waiting for these risk scenarios to come all together and give AUD a boost, and possibly even Euro USD. Last thing I wanted to have a look at is USD Cnh, which was one of the key drivers for the dollar bearish move last year. It is sort of, again, this part of the year, the last 2 weeks has been finding it difficult to hold the lower pricing down. The People Bank of China has made some moves. They made a bit of a risk off tone, to be honest. I'm not going to go too much into the details, but they made a couple of moves that made the downtrend a little bit more difficult to resume, which explains some of the congestion on the major FX space as well. I keep a keen eye on what happens on USD Cnh. If there's going to be a move higher, I'll be looking 650 to hopefully cap it. If it's going to keep coming down lower than any of these lows, it's really subjective. Target is really to move into 635 in this year. We covered that. Have a quick look at gold because a lot of people were asking about gold. The thing is about gold, you have real yields a little bit rounding up and starting to move a bit higher. The big trade of this year is reflation trade. That means there's money to be made, there's profits to be made, and investors usually only interested to buy gold if they're worried about the economies, if there's a high risk. But on everybody's paper, on everybody's projection is that the second half of the year is going to be extremely good, and there's not really a lot of point to hold on to gold as a risk asset. Really what you want to do is you want to sell gold and buy riskier assets because they have a higher chance of giving you a yield, a dividend, and profitability, where gold doesn't pay anything. It's just really an asset to hold against risk of events. So as the reflation trade as a whole is coming along, the whole idea of holding gold long is becoming less and less attractive. I believe we're going to see a bounce if market moves back into the 1770 level, 1750, but I believe the bounce will be temporary. Since pretty much in beginning of August, when the reflation trade really picked up, we saw gold coming down, and there was two big spike downs, one on the 9th of November when officially Biden became the winner of the election, and then we saw another spike randomly into that area, and it continues to keep selling off. So really my thinking is that the gold bull move has probably found an end, regardless of where USD will be trading. If you find it moving higher, I think I will start getting worried about the reflation trade as well, because investors will start moving into gold. But until then, there is not a lot to love about gold right now. Even with inflation moving on, there's loads of riskier assets that pay dividends and pay yield and more interesting to hold. It was a little bit of a longer video because I really wanted to understand what happened last week in terms with options flow, what's going to happen continuing, and have a quick look at this calendar as well. That's the end of this video. Thank you.